Hey guys, it's Mike from Modano, and in this video, I'm going to show you how to add budget variance analysis to your financial model. Now, budget variance analysis is really confusing for a lot of people, but in essence, it's just the process of creating some forecasts that you store away. So as you roll your model forward throughout the year, you can compare them to those forecasts. Those forecasts are called your budget, and it's normally prepared at the start of a financial year. And then over time, you compare, and that variance analysis gives you an understanding of whether or not you hit your targets. So when building a budget variance analysis model, you really want to start with a monthly historical and forecast model with, ideally at least 12 months of historical data. So you can do year-on-year comparisons, like prior year versus current year, and also with ideally starting at the start of a financial year. So this model, this company in this hypothetical example, its financial year end is December, which if I go to the time series, you can see its financial year end is December, and its first financial year is 2020. So imagine at this point in time, it would be December or January 2021. And we would literally be sitting there saying, let's create a budget for the year before we get going. So to do that, what we need to do is capture the forecasts that are in this model in the financial statements from January 2021. So basically from January 2021 through till December 2021, this right now, at this point in time, is my budget. Imagine you're in December 20 or January 21, my budget and my forecast are the same thing. So I want to get a snapshot of that. And to do that, I'm going to insert a budget income statement module so I can store a snapshot of those forecasts. So you'll see here, I've got a budget income statement module here and insert module from web, budget income statement chart of accounts 5, which was the chart of accounts that was used to create this model. So you'll see the budget income statement really is just an income statement with a whole bunch of assumptions designed to capture the outputs from the forecasts. So you'll see it starts in January 21 because as per my time series, I've set my first budget period January 21 with 12 periods. You can change that, but in this case, it's consistent. And what I want to do is import the data from my financial statement. So I'm looking for, in this case, for January 21, I'm looking for 2152 coming in. And if I go to my budget income statement, I can just use the import assumptions tool. And instead of importing from connected assumptions like when live linking, I can just import from Excel, select the module component, the income statement module component in this model, and automatically bring that in for all periods. So I don't need a mapping file here because it's automatically mapped to the income statement, and it's going to bring that in. You'll see there, that's my 2762.8 for December 21. If I go back to January 21, January, I've got my 2152.6. So I can just import that data. And once I've done that, you can see I've got my budget for the 12 months. My NPAT total is 1586.1. If I now go to my forecasts for my financial statements and I look at January 21 through to December 21, I've got my 1586.1. So I basically got a snapshot of my budget. Now I've got a snapshot of my forecast, which is my budget. Now, for comparative purposes, you really want to use some type of dashboarding to compare budget versus actual. So I'm going to insert what's called a budget income statement summary dashboard. I'm going to use this small one here because it's got a nice summary. It's got a nice tight summary compared to the large one, which is A3. I'm going to put this in. What this budget income statement summary dashboard is going to do is compare my forecast in the model to the budget that I've saved, which at this point in time should be 0. I should have currently 0 budget variance analysis. Okay, you'll see when that goes in at the moment, all of my data is forecast. And you see down here, I've got my projected income statement, which is my forecast for the year. And then I've got my budget. They're exactly the same, so my variance is 0. So at this point in time, my budget equals my actual, and there's no variance. Now, this is now the start of where you start your financial year. But what happens is, as you roll your model forward, there will be variance because you almost never hit your targets exactly. So if I change my last historical month here now to January 2021, it's going to roll my model forward to include an extra period of historical data. In this case, this is live linked this model to 0. So it's going to update the income statement and balance sheet for January. And that data is going to automatically populate and map because I haven't changed the chart of accounts. Boom, rolled forward my model. So now I've got my January 21 data in my historical balance sheet, and I've got my January 21 data in my historical income statement. And if I now go to my all periods financial statements, I now have in here, January 21 is now an historical period, which is why it has an H next to it. And if I go to my financial statements here, you can see in my annual income statement summary, I now have the first period as an historical period. And if I go to my budget summary, you can see here, we forecast the budget, we forecast 2153. We actually did 2114. So we actually, our budget variance here ended up being 38 below what we expected. We ended up being 10 below on gross margin, 25 below on net profit after tax. So here you can see your actual versus, you've got your historical, forecast, and then budget. So you can see we were below budget for this period, and that's the rolling nature of the forecast. We can also go in now and what's called reforecast. So if we came in here now and said, actually, I'm expecting May to be closer to, say, 1200. I'm expecting July to be closer to, say, 1200 as well. Then I can go back and I can say, okay, let's have a look how that's going to compare. And you can see now we have those comparisons. We've got margin based on those. So you can see we're ahead in those periods. So for the year, we expect to be up. And that's called reforecasting. So technically, you roll the model forward each month. You compare your actual data with your budget that you prepared prior in the year. And then you actually reforecast and compare your reforecast to your budget. And that's budget variance analysis. You can also create a new budget each month if you like. In any case, the whole purpose of this is to create some degree of accountability and direction for your business. It's very powerful and something once you've got the hang of base financial modeling, you really should consider doing. Now, if you're interested in learning more about budget variance analysis and how it actually works, we'd recommend going to the training section of your Modano account. And under the financial modeling section, there is a budget variance analysis exercise with videos and practical and theoretical assessment exercises that explains the whole process of how the budgeting process works, what a roll forward is, how you create your budget, how you roll forward, and how to think about the process of reforecasting. So there's a lot of resources on this, and obviously you can contact us for support if you need it. Good luck, and I hope this helps you.